unit economics and margin. So we've talked through the 6 layers of AI costs. You now have a map of where the money goes. Let's zoom into a very important number that tells you whether your business model works. This number is called gross margin. I had mentioned it in the previous section, but here I want to focus on it. And I'm going to focus on it predominantly using examples and growth rates of known AI companies. So this section is going to be very examples heavy. Let's get into it. Firstly, what is gross margin? Before going any further, I want to make sure that everyone is comfortable with the concept. Gross margin is simply this. For every dollar or euro of revenue you bring in, how many cents are left over after you pay the direct cost of delivering your product? That's it. If you charge $100 and it costs you $30 in compute and API cost to serve them, your gross margin is 70%. You've kept the 70 cents on the dollar, and the other 30 cents went to the costs, the tokens, the GPUs, and the infrastructure we spoke about in the previous section. Why does this matter so much? Because gross margin tells you how much money you have left to pay for everything else. That is, your engineers, your sales team, your office rent, your marketing, and even your coffee budget. If your gross margin is high, let's say 80%, you have a solid cushion. You can afford to spend aggressively on growth, hire ahead of demand, and invest in R&D. If your gross margin is 25%, you are only keeping 25% for every dollar you make. That's a very thin margin to build a company on. It means every dollar of operating expense has to be justified because you have very little room for error. Now let's talk about the current benchmarks of AI companies so you can understand how important this is. Starting with traditional SaaS. In traditional SaaS, as mentioned, a healthy gross margin is 75% or above. The best-in-class SaaS company often run at 80 to 85%. Some even run at 90%. The median SaaS company sits around 77%. These are businesses where the cost of serving one more customer is almost negligible. As mentioned, AI companies look very different. Now let's dig into the current gross margin across different archetypes of companies. Based on a 2025 industry reports that studied 25 of the fastest growing AI companies, they identify 2 distinct archetypes. And these archetypes are what we're going to use to talk about the current status quo for the gross margin in the market. The first group, we call them supernovas. These are companies growing at an incredible pace. These are startups that have hit around $40 million in ARR in their very first year of selling and are quickly growing to about $125 million by year 2. The annual recurring revenue number is the headline number that defines the size and the trajectory of a subscription business. So these supernovas were reaching $40 million in annual recurring revenue in year 1. That's extraordinary growth. But here's the number that you need to look at. Yes, that special number, and that is, what is the average gross margin? It turns out the current average gross margin of those businesses is just 25%. And in fact, some of them are even operating at negative gross margin. This means that they are losing money on every customer that they serve. Essentially, they are paying more in compute and infrastructure than the customer is paying them. The second archetype was what we called shooting stars. These are companies that also grew fast. $3 million ARR in year 1, roughly scaling to 100 million ARR by year 4. Incredible growth by historic standard, but they sustained their gross margins at around 60%. That's obviously still below the traditional SaaS benchmark of 75% plus, but that's a much better workable number. You can build a real sustainable business on 60% margins. You still have room to invest in growth, hire the team you need, and even weather a bad quarter. One industry observer summarized the tension. No one in AI has really achieved 80 to 90% gross margin. One more thing that I think is worth mentioning. As you probably noticed, the old SaaS growth playbook has been updated. For years, the gold standard was something called triple, double your revenue in successive years. That was considered elite growth for a SaaS startup. The new benchmark for AI companies or AI products is quadruple, triple. The best AI companies are growing at nearly twice the pace of the best-in-class SaaS companies at the same stage. But here's the difference. Those SaaS companies were growing at 80% margins. These AI companies are growing at, as we mentioned, between 25 to 60% margins. So yes, these current AI companies today are growing fast, but with 25 to 60% gross margins. Whilst the speed of growth is incredible, the underlying gross margin is simply not there yet. So now let's think about a specific example. Let's take Perplexity. Perplexity is an AI search engine. They've grown to around $200 million in annualized recurring revenue, processing roughly 800 million queries a month as of mid-2025. The growth is genuinely stunning if you think about it. We are not able to confirm because we don't have the data, but Perplexity has been widely reported to operate at deeply negative margins. That's around negative 200% profit by one estimate. In plain English, for every dollar they earn, they are roughly spending about $3. And they've raised over $1 billion to fund this approach. And their valuation has hit $20 billion in late 2025, roughly about 120 times their revenue. Now you may think, why? The game that these companies are playing is really capture the market now and then fix the margins later. But that's not necessarily a game you can play. Whether the bet pays off is one of the biggest open questions in AI. And by the way, Perplexity is not the only one in this strategy. There's a fascinating dynamic called the token data war. The progression goes like this. Companies charge a premium on top of their model's raw token costs, and then they move to flat rate pricing, and then they make it free. And in some extreme cases, companies are now essentially paying users to use their product because customer interactions generate valuable data that improves their products and makes the product stickier. Coding agents are the clearest example. OpenAI's Codex and Google's Jules are being given away at near zero cost, bundled in with existing subscriptions. Because the data these tools generate is worth more than the compute cost running them. It's important to understand this dynamic, even if you're not operating at that scale, because it tells you something about the competitive pressure you may face from well-funded competitors in your category who can afford to operate at a loss. Now let's look at another company, Lovable. Lovable is an AI-powered app builder out of Sweden. They have been able to hit $120 million in ARR in just 7 months. The pace is almost unprecedented. The user base is split in the following ways. 80% of people are building real complex applications, 10% are enterprise customers demoing new products, and 10% are using it as a no-code website builder. Their business model uses usage-based pricing, which means that their revenue scales naturally with their costs. Whether they've achieved positive gross margin is not clear, but the architecture of the business at least tends towards a natural alignment between what they charge and what they spend. So here's the takeaway and the task that I want you to carry out. You need to calculate 3 numbers for your AI products. One is, what is your cost per query? Essentially, take your monthly COGS and divide it by the number of queries or user interactions that you have. Secondly, what is your cost per active user? That's essentially your total COGS divided by your monthly active users. Third is, what is your gross margin percentage? You calculate this in the following ways. Revenue minus COGS divided by revenue. If you don't know these numbers yet, because you haven't launched, estimate them. Use the API pricing we've discussed. Add 30 to 50% for infrastructure overhead and model it out. These 3 numbers are your economic vital signs. Track them monthly and track whether they are improving or getting worse. If they're flat or declining as you grow, that's a red flag. If they are improving, this shows that you are potentially building something sustainable. And you should have a plan to improve your margin over time. You want to build a business where the margin gets better as you get bigger, not worse. The difference between those who have a sustainable business or product and those that flame out is whether you have spent time understanding these economics early enough and designing for them in your product and in your strategy. Let's talk about another level you have to improve your gross margin and your unit economics. That is how you price your product. Thank you.